Welcome to Animal Spirits with Michael and Ben. Yesterday, the stock market went crazy. We're filming this on Tuesday morning. Stocks were up.
Wait, define go crazy.
Well, stocks were up 3 to 4%. And on the smaller end, small mid-cap stocks were up 6-7% in some cases in terms of the indexes. That seemed like a pretty crazy day to me. And it sounds like the reason for this was because this company, Moderna, said that they had some promising early signs of a vaccine. And does this stuff surprise you at all when you get data like this? I mean, are we going to have some massive volatility from the vaccine in the coming months where you get some good news and markets go crazy, and then you potentially get some bad news and then they give it all back? Doesn't it seem like that would be a fair assumption of what's going to happen? Because it sounds like it's going to take a while for this to actually happen.
Yes, I could definitely see that happening.
So this company that I had never heard of before was $6.5 billion market cap at the beginning of the year. As of yesterday, they were like a $30 billion market cap. They're up 350% this year. It's crazy. Think about this. I'm not trying to get ahead of myself here, but if when we do get a vaccine that works, and is that the kind of thing that's priced in at that point? Like, can we get to the point where it's so telegraphed and we know enough from these trials and then the ramping up of production that's one of these weird sell the news events, like when it actually happens? Is that getting too far myself?
I think that's absolutely possible that the economic opening is not as strong as the market has already anticipated. And I think that the market is too sanguine here. Not to be so arrogant to call the market wrong, but if
you've been calling the market wrong for like 4 weeks. Come on.
If the economy, excuse me, sir. Sir,
you're a non-believer. The Dow is going to be at 40,000, and you're going to say this doesn't make sense.
Dead cat bounce. No, dead cat bounce. The market go to 50,000, I still wouldn't trust it. But here's what I'm getting at. If we have an economic reopening, and what do you think we get back to, like best case scenario? And I'm not saying 3 years from now. I'm just saying next 6 to 12 months, we open up, everything's up and running. Are we 90% of the way back?
I think if we got to 90% of the way, I think that if we got to 90%, people would be thrilled. There's no way we're getting back to that. I don't think.
Okay, exactly. So I think it's, and I am pulling this number directly out of my butt. What if we get 80% of the way there? So I don't understand how the market is where it is. And we've been through this a million times. I understand what's driving it, but I think that this.
But I'm saying it in some ways it makes zero sense. In other ways, is the market willing to forgive that 80% number under the assumption under the assumption that we're going to have a vaccine and then this is all going to be over? And so is the market able to be forward-looking enough to say, let's just throw the next 12 months out? Is that possible? It doesn't seem like it would make sense because people think the market is so short-term looking.
No, I don't. I'm having trouble wrapping my head around this because
trust me, I am too. But that's the leap I'm trying to make. That maybe this is the market. This is what the market is saying. Like, okay, we know the next 12 months is going to be bad, but we know what the end is going to be.
All right, but hear me out. It's not like we were trading at a 12 forward multiple or anything like that. You know what I mean? It's not like stocks were cheap before this. So the idea that earnings are going to recover 100%, which are not, and the idea that investors are willing to pay the same multiple pre-crisis, post-crisis as they were pre-crisis, that sounds completely inconceivable to me.
Do you think it is also conceivable that, let's say this isn't a sell the news event, could this thing lead to a stock market bubble after this? Like, could we not get like a crazy euphoric, oh my gosh, this is over, release, and instead of the stock market giving it back, like
here's how potentially that could happen.
I think that's a possibility that we could see a bubble from this. How crazy would that be?
What if I feel like you won't let me speak.
How do you like it? How do you like being on the other end of that?
If the economy reopens and all of this relief money comes flooding in and consumer spending somehow hits an all-time high, I suppose in this crazy world we live in, perhaps a stock market bubble cannot be taken off the table. That sounds so ridiculous coming out of my mouth. I don't believe it. I'm throwing it out there that could be
I mean, think about how this is.
We went from, we went from depression talk to bubble talk in 5 weeks. That is some serious mental gymnastics.
Yes, yesterday surprised me that stocks were up that much on this news. That it was the CEO said the data couldn't have been better, and they're doing human trials. Which I was thinking.
Oh, the CEO said that. That's so weird.
Yeah, surprise. Right. Obviously, they have something to gain from this, but obviously, on the other side of it, if he's lying, they're going to see a downfall if and when that news came out. So there was a blog post that made the rounds last week called DoorDash and Pizza Arbitrage.
Blog post of the year, easily.
It was pretty good. So this is by a guy named Rajan Roy, and we talked about DoorDash last week about how it doesn't seem to make sense as a business model, and the fees don't make sense. So he wrote a piece talking about, he first of all, he showed all the places that, he said Grubhub lost $33 million in Q1 on $360 million of revenue. DoorDash lost $450 million on $900 million in revenue in 2019.
Jeez.
Uber Eats, he says, is the most profitable division of Uber, and it lost $461 million in Q4 of 2019 off of revenue of $734 million. So again, I think a lot of people are learning throughout this that restaurants are a very low-margin business. And so trying to add another low-margin business on top of a low-margin business just doesn't seem to make sense. But
what was tell everybody the punchline here for people that didn't read it.
But the crazy thing about this is, as these companies were trying to gain customers, and a lot of them do so at a loss because they're being funded by venture capital firms, and the idea is get a bunch of customers, bring them on board, then you can, once you have them and you have scale, you can start making money. And what they found, he looked at a friend's pizza joint, and DoorDash was selling $24 pizzas for $16. And he said, this is an arbitrage because you're getting $24. The restaurant owner is getting $24, and DoorDash is only getting $16. So he started buying, hundreds of pizzas, I guess, or maybe dozens of pizzas to pocket a difference for the restaurant owner. So he was buying them for $16, but he was himself being paid $24, and DoorDash was eating the loss. So obviously they were doing this to gain customers, and now that they have customers like you and me, they've decided to jack up the prices and go the opposite direction.
And they still can't make work. So these are my two favorite lines in the post: raise a ton of money, lose a ton of money, and just obliterate the basic economics of an industry. He later said, this sometimes feels like the greatest ZERP story ever told. And at the epicenter of this ZERP story has to be obviously the Federal Reserve. And business models like this are largely funded by companies like WeWork with their Vision Fund. I'm sorry, SoftBank with their Vision Fund.
I don't think that's where he lost me, though, the ZERP thing. Zero interest rate policy had nothing to do with venture capitalists funding a company like this. Venture capitalists don't care about interest rates, right? Why would they care about interest rates?
I think, hold on, let me try and put this into words. I think that this all comes full circle in terms of just money is free, do anything, costs nothing to borrow. And I understand they're not raising money from banks, but I think it's just this mentality of
it's a risk appetite thing. I can see that,
yes.
But I think this is also Silicon Valley thinking, oh, we're going to be the Uber of, and then they decided the Uber of food delivery, and then they got in there and realized this is a really tough business model. And honestly, even if all these big places, Postmates and DoorDash and Grubhub and Uber Eats, they all came together and formed just one entity, I think it still wouldn't work, right?
But I agree. It's the economics doesn't work. But here's the thing: if money costs nothing, then what's the problem with lighting it on fire in the short term, and you'll figure it out later in the long term? That's what it is, I think.
You've gone fully. You're fully there as a Fed hater. You should start wearing a bow tie. This is the reason this doesn't make sense from a venture capitalists have always taken huge risks. And
it's not about VC,
and they're not borrowing
it's about
money
the system.
to do it.
It's about the system.
Yeah, I just don't think that technology. I don't think that people are funding venture capital things in Silicon Valley depending on, well, if it was 4% versus 0%, I think I would be making a different decision.
Listen, if DoorDash borrowed money at 3% and started buying back their stock, you would be all for it.
Oh, man, he's a Fed truther, folks.